Love this chart, which you alluded to. The white line is this global economic policy uncertainty index, which is clearly rising. The red line is the fear index, the VIX, the volatility gauge. Why is there such a divergence between the two right now?
Oh, that's a good question, and I've struggled to understand myself. It's not hard to conjure up a huge range of different risks out there, from the collapse of globalization to trade protectionism to question marks about whether the growth positive stimulus coming out from the US will disappoint markets, to Eurozone political risk, to Brexit. But markets have shrugged that off. And I guess it makes sense in one sense, which is that realized volatility has been very low. Last year, when there was two big event risks from the US election and Brexit, a market rally continued in earnest. So cost of hedging risks is pretty high, and alpha is hard to generate these days. So traders are just sitting back, shrugging off some of those risks, and based on last year's performance, a lot of analysts say, who can blame them?
Yeah, but is the reflation trade still on? I mean, if you look at inflation expectations rising, inflation's rising. This is another chart which we've titled Analysts Behind the Inflation Ball. This tells us that inflation is beating economists' expectations.
Exactly. Over the last couple of quarters, we've seen an upturn in measures of price pressures, and we've seen US inflation expectations rise, not just because of the US election. Really, we've seen firming macroeconomic data all around the world, from positive manufacturing reads in Asia to Eurozone buoyant consumer sentiment. So that really is a story dominating markets. Global reflation, a surge in headline inflation. But what is a real question mark for markets now is whether core inflation will rise. With this big rally we've seen in inflation-fueled trades, will it be justified by economic fundamentals? So that's really the question on the lips of market participants right now.
Well, and what's so fascinating is that we haven't seen a rise in the VIX with all of this movement. In fact, if you dip into my Bloomberg SID and chart 5080, you'll see that, the VIX is extremely low, where something called the CBOE skew index has been rising steadily. And okay, so you see it's not as high as it was, but there's a big difference there. What's the reason behind this?
Well, the skew index is really derived from tail risks. So investors are punting on low-cost hedges against tail risks. At the same time, a real question mark about why the VIX is low. And I think that realized volatility is low, and implied volatility is mathematically derived in part by realized volatility. So market participants reckon that maybe it would be quite costly to pull on some of those hedges. So maybe they think they can hedge their portfolio by sector rotation across asset classes. But yeah, we've seen the VIX, which many people describe as the fear index on Wall Street, but many people might actually say that it's a false indicator of market signals going forward, because historically a low VIX and a high VIX read has not necessarily been correlated with S&P gains.
Is there any asset class right now that isn't touched by what Donald Trump is doing?
I really wish I had an answer for that. Maybe municipal bonds in Guinea, maybe stocks in Rwanda.
We're scraping the barrel, aren't we?
Yeah,
we're scraping
completely.
the barrel.
I think that just really Trump really is a story for global markets, even within the Eurozone. You've got question marks about how a regulatory, reordering of the capitalist order in the US will kick off, and that's really going to have big repercussions across asset classes.
Which means, Sid, you'll have to come back again and again and again and tell us all about it. Thanks for